Trump's Trickle Up Tax Cut. With the recent passage of the Republican tax plan, the howls of protest from the progressive left have reached a crescendo. Their skewed analysis has unerringly returned to the economic tropes so long favored by the Democrats. Tax cuts for the rich, for the Republican donor class. Those are the motivations most frequently cited by the critics as they identify the more egregious provisions of the legislation. Indeed, I've heard more than a few pundits in the mainstream media resurrect one of the left's long-standing favorites, trickle-down economics. Though mostly pushed by journalists, more than a few left-wing economists, Joseph Stiglitz, Paul Krugman, Thomas Piketty, to name a few, have made similar complaints about the purported distribution of the benefits flowing from tax cuts. Trickle-down economics is a faux theory that implies the bulk of any immediate benefits due to a reduction in tax rates flow to the capitalists. It's only after the rich have reaped significant increases in wealth they are so prone to hoard, that they deign to increase their spending a bit, and a few crumbs of their good fortune gradually work their way down to the benefit of the middle and lower income classes. Of course, that's a gross misrepresentation of economic reality. Even a cursory review of economic history shows that it is actually the lower quintiles of the income distribution that realize the largest and most immediate benefits in terms of the impact on their financial circumstances as a consequence of any major reduction in taxes. But then the left can't let reality get in the way of a good narrative. In fact, if any recent economic policy truly deserves the appellation trickle-down economics, it would have been the economic programs pursued during the Obama administration. Despite the rhetoric and stated goals of its policies, the age of Obama was one of well below average economic growth that greatly disadvantaged poor and middle-income families. Regardless of his intent, Obama's economic stewardship created a widening of economic disparity that resulted from the rich getting richer while the poor got poorer. Perhaps its antecedents go back even further in history, but my first recollection of the phrase trickle-down economics was its use in describing the policies of Ronald Reagan. Though it is a description disconnected from the actual economic dynamics that flow from a reduction in taxes, there's no denying the visceral appeal of catchy phraseology. No doubt the historic dominance of the progressive left in the media and educational establishments had allowed them to draw on the talents of a majority of professional wordsmiths. That had long proven a source of the left's historic advantage at influencing public opinion. Fortunately, that does seem to be changing with a flowering of independent voices in the new medias, perhaps most especially typified by the anti-SJW skeptic community here online. As noted above, the typical formulation of the argument that supports the interpretation of taxes as trickle-down economics gets the flow of benefit realization almost exactly backwards. Tax cuts don't result in a rebate of earlier tax payments. They are a reduction in tax rates that will be applied to future earnings. That prospect incents many businesses to expand to capture a larger benefit. The lower tax rates will be applied to a greater income base in future periods as a result of increased investment in the near term. Much of the initial gain from tax rate reduction is realized in the form of expanded employment and ultimately in higher wages, both factors most heavily benefiting the working classes. Consequently, the greatest impact of the short-term benefit is seen in the wage packets of the newly employed and eventually in higher wages for most workers. Over time, the benefits trickle up as business profits increase and expectations of future profit increases get reflected in higher stock prices. Lest that cause some to cavil at the thought that this is how the wealthy capture the bulk of the benefits, the fact is that a significant portion of stock price gains accrue to the benefit of middle and lower classes as a majority of stocks are held by institutions, and workers realize a significant share of the increased wealth due to higher stock prices through gains in their 401ks, IRAs, and other retirement accounts. That has been the dynamic that has played out in the aftermath of every major tax cut. A brief review of economic history would demonstrate the above effects were the outcome of all 4 major tax reductions enacted over the last 3 generations. It proved true for the major income tax rate cuts by JFK in the early 60s, Reagan in the early 80s, and Bush the Younger early in the new millennium. It was also the outcome of the Clinton cuts in capital gains tax rates in the mid-90s. Though much of the blame for misrepresenting the economic impact of tax cuts can be laid at the doorstep of progressive pundits in the media, a fair share of any blame accrues to the economics profession. Their desire to sit at the right hand of power and provided advice has proven all too alluring for many. Often such counsel would be more accurately described as justification or rationalization for policies that have a politically correct philosophical pedigree, despite being of questionable economic merit. Many economists have been quite willing to provide the patina of legitimacy afforded by an apparent conceptual basis for such interpretations. That so many would spout such nonsensical theories, interpretations that invert economic reality, no doubt follows from econ departments at universities succumbing to the wave of postmodernist thinking that has swept through most of the educational establishment. As cultural Marxism has come to dominate their worldview, like much of the professoriate outside of the STEM fields, many economists obsess on wealth. As a result, they have come to place excessive weight on the wealth effect, and in turn, the related spending and its impact on economic growth. One unfortunate consequence of their postmodernist worldview is that a majority of academic economists, many of whom round-trip through government advisory positions, are no longer objective scientists. No doubt, every person carries a range of biases that cannot help but color their opinions and judgments. However, it seems that much of the economics profession has discarded Milton Friedman's admonition that economics be a positive science. Based on recent polls of academe, apparently somewhere between 2/3 and 3/4 of college economics professors describe themselves as progressives or left-leaning politically. As a result, their views on social justice color not only policy prescriptions, but also influence the design of economic models and interpretation of data. In other words, they are no longer social scientists. They have transmuted into social justice scientists. That skewed worldview no doubt contributed to the misinterpretation of the strong economy of the 90s. Many economists at the time attributed the increase in GDP growth rates to the wealth effect attendant upon rising stock prices. The bulk of the increase in spending was not due to the wealth effect from the appreciated stock portfolios of the already wealthy. Rather, it was due to increased spending by the working classes. In part, it reflected a belief that it wasn't necessary for them to save as much for retirement. Certainly a contributory factor to increased consumption spending was the expanding value of workers' retirement accounts. Nonetheless, the increase in current spending was from greater wage income. And Uncle Milty would have ascribed the higher level of consumption spending to the belief that their lifetime earnings were going to be much higher, because the economy would be able to sustain permanently higher rates of real GDP growth. Hey, it was the 90s, almost a reincarnation of the Roaring '20s. A fair analysis would have attributed the bulk of the spending gains to the expansion of employment and wages. However, that wouldn't comport well with the social justice perspective now preferred by most academic economists. Their worldview, steeped as it is in class conflict and income disparity, necessitated an emphasis on wealth. It is quite possible that such a perverse perspective on economic reality had a direct impact on the types of policies promulgated during the Obama era. As described by its own spokesman and economic advisors, the Obama administration enacted policies expressly geared to raising asset prices, believing that would engender a wealth effect similar to what they had discerned as the primary driver of high rates of real GDP growth in the 1990s. That would ultimately spur higher levels of economic activity. Higher asset prices would lead to increased spending by the wealthy, who do indeed own a majority of stocks held by individuals outside of retirement accounts. Increased spending by the wealthy would result in expansion by businesses to meet the increase in demand. Satisfying that demand would cause businesses to ultimately hire more workers, thus finally benefiting the middle and lower income classes. Gee, didn't that turn out to be a smashing success at spurring the economy over the Obama years? Also, note the implied transmission of the intended benefits of the Obama-era economic policies. Sure as hell sounds to me much more like the flow of benefits the left-leaning pundits regularly characterize as trickle-down economics. A few final thoughts on the specifics of the recently enacted tax plan. Despite the howls of Democrats and the mainstream media pundits about the benefits flowing to the wealthy, more than any of the above-cited tax cut policies, the Trump-era plan seems much more focused on providing benefits to low and middle-income families. All one needs to do is consider the smaller cut to tax rates for top income brackets and the closing of Internal Revenue Code loopholes that primarily benefit high-income households, such as the limitation on mortgage interest deductions and the write-offs for state and local income tax payments. Beyond that, it has long been recognized by objective economists that corporations pay no taxes. Of course, they do so in a narrow sense. Obviously, corporations do send tax payments to the government based on their reported profits. But that is an overly literal interpretation of who pays the tax. The corporate income tax is properly characterized as an indirect tax, one for which the burden is actually borne by others. The weight of the tax is borne jointly by consumers, owners, and workers, the latter of the three groups taking the brunt of the impact. Customers are disadvantaged due to what economists characterize as a reduction in consumer surplus. They lose through a combination of greater out-of-pocket costs on items purchased and lower consumption because of purchases discouraged by higher prices. Owners suffer due to a reduction in profits from lost sales and a higher tax bite out of the smaller pool of profits. Workers suffer the greatest hit due to reduced employment and lower wages. Most recent studies conclude that workers' wage losses due to both factors are much greater than the decline in business profits. A number of recent studies have estimated the reduction in wages at 4 to 6 times greater than that of profits. Lest that seem overstated, just consider typical U.S. business profit margins compared to their wage costs. Average U.S. corporate net profit margins are in the low double digits. Labor costs are the biggest category of expenses for most industries, often well over 50% of total operating expenses. Given those numbers, a 4 or 6 to 1 ratio seems an intuitively reasonable ballpark estimate. This is Dismal Scienter signing off until next time.